Good morning everyone, and welcome to another RF Crypto video. As you can see from the prices, there has been a further decrease in the price of cryptocurrencies, and the global crypto market cap has gone below $900 billion. The market's shed almost 70% of its value in the last 3, 4, 5 months, and it shed half its value in a couple of days. Bitcoin is down by almost 40% in the last 7 days, Ethereum by 42%, BNB 31%. So just in the past week, the crypto markets lost 1/3 of its value. It lost 30% of its value. And obviously this is extremely concerning, and it has everything to do with how the Lido Finance's staked Ether has depegged from Ethereum, and how so many of these decentralized finance platforms such as Celsius, which we'll speak about in a bit, use staked Ether to add liquidity to their portfolio and generate income for their clients. So looking at the markets, they're not doing well at all. You can see here that the price of Bitcoin is inching towards 20,000. Let's look at the charts now. I think we even have to squeeze this a little bit more. If you sort of look at the last crash, which saw the price of Bitcoin going to 30,000 on the 9th of May, it kept on trading on an average of 30,000 for about a month. And at the end of that month, on the 10th of June, the price has just collapsed. And you can see significant red candles going on here, which coincides with excessive selling volume. And this has caused so much downward pressures in the market that not even the bulls, represented by these two little green candles here, they couldn't even push the prices up because the selling pressure is so incredibly high. And we are seeing bleeding from the markets. A lot of people are moving away from crypto back into safer assets like stocks and bonds. And this has caused a lot of liquidations, and a lot of people have lost money because of this. Because if you look at here, over the past 24 hours, $321 million worth of trades got liquidated. So that's about 111,000 traders. And if you look at here, these are in the long positions. So what happens if you have leverage positions and you expect the price to go up, you get long positions, whereby if you have $100 and you have 10 times leverage, you can invest up to $1,000. So if you invest that much and the price of Bitcoin drops so much that the value of your portfolio drops from 1,000 to 899, then you are making a $101 loss, but your initial investment is only of $100. So what happens then? In order to protect themselves, the exchange closes your position so that they can recover whatever they can from the loss, and your portfolio goes to zero. And this is what these liquidations represent. And 321 million is a lot of money. This is what people lost just in the last 24 hours due to the decrease in the price of Bitcoin, Ethereum, and all other cryptocurrencies. And looking at the past hour, the short positions are dominating the long positions, which means that people are getting into leverage positions, but they expect the price of Bitcoin to go down. If people are in the short position, they'll only profit if the price goes down. So we can see clearly that there is still a lot of selling pressure, and it doesn't look good. I think that the price of Bitcoin might go down below 20,000, and 20,000 is another psychological level like 30,000 was for the past month, and it might be trading along that level for a while. But I think that with all the selling pressure going on, and with staked Ether still depegged from Ethereum, there is a lot of selling pressure. If we switch to Ethereum, it's even more dire. The selling pressures are very, very high. Looking at the last 15 minutes, we see here 62%, 59%, 51%. So the selling pressures are still there. People are still betting that the price will go down. If we look at the fear and greed index, I don't know if I've ever seen it so low. It's 7 out of a total of 100. It's extreme fear. People do not want to invest in crypto at the moment, or people who have invested in crypto are cashing out and they're pulling their money to safer assets like maybe stocks, bonds, and safe metals like gold. So the picture seems very dire. However, we have seen crashes before and we have seen recoveries. So I'm pretty confident that there is a rough patch ahead, but recoveries will take place due to the fact that blockchain is a technology of the future and crypto follows it because it uses that technology. Celsius's liquidity crunch, which has caused it to halt withdrawals and has caused the crypto market to crash even further to about $22,000, is linked to Lido's staked Ethereum, or stETH. So crypto lending company Celsius is one of Lido's principal clients and one of the largest holders of stETH, or staked Ether. The problem with this is that staked ETH is always supposed to be worth 1 Ethereum, and it hasn't been for some time now, which means that it's lost its peg, which translates to a big problem because it is similar to what happened with UST, whereby the value that they're holding, they think it should be equal to ETH, but its value is less than that. So staked ETH basically represents Ethereum that's been locked up on the Ethereum 2.0 beacon chain, a network that will soon be merged with the Ethereum mainnet. This Ethereum mainnet is in a highly anticipated upgrade that will transition the blockchain from proof of work, which it currently is, to proof of stake. Normally, what happens is that users need a minimum of 32 Ether, which is worth around $40,000, to participate in Ethereum 2.0 staking and earn rewards. However, Lido Finance, which is the custodian of staked Ether, makes it possible for users to stake any amount of ETH. And because it's liquid staking, it gives users staked Ethereum tokens in return, which is stETH. That staked Ethereum can be lent, it can be staked, and it can also be traded for other coins. And Celsius does precisely this with its own clients' funds. But now, a day after Celsius paused customers' withdrawals, swaps, and transfers to put Celsius in a better position to honor its withdrawal obligations, as they say, there's a growing concern over the lending companies or Celsius's exposure to staked Ether. The company has at least $475 million worth of staked Ether in a public wallet. And this is a big problem because the big exposure to a coin which has been depegged from Ethereum, and it's a relatively large amount that serves as liquidity for Celsius. Basically, Celsius works by staking customer deposits, which in this case is Ethereum, in yield-generating DeFi protocols such as Lido Finance. In return, Celsius receives staked Ether, which increases in value as deposits earn rewards. Celsius makes money by basically paying its customers a promised rate of return, which is between 6 to 8% for Ethereum, closer to 6%, and they keep the rest. So they make about 10 to 14% on that deposit. They give 6 to 8% to their users, and they pocket the rest. Basically, what the value proposition for Celsius depositors is that they're promised a fixed rate of return on their ETH and leave it to the company, or Celsius in this case, to figure out how to reliably generate that return. But what happened is that the strategy starts to come apart if staked Ether loses parity or loses its peg with Ethereum, which it has done in the past week. And at the same time, there are lots of Celsius depositors or clients who are looking to withdraw their Ethereum because Celsius doesn't appear to have enough liquid Ethereum to meet its obligations. So here we're not talking about staked Ethereum, we're just talking about normal Ethereum. And by Monday afternoon, staked Ethereum had yet to pull even with Ethereum. It's still not pegged, and it was one staked Ether was worth about 0.94 Ethereum. And staked Ether has been trading below 1 Ethereum since last month, when staked Ethereum was impacted by the Terra USD and Luna collapse. So a large public Celsius wallet shows 475 million worth of staked Ether, as I said before, being used as collateral for hundreds of millions in stablecoin loans. And there have been efforts to find other public wallets, but there hasn't been any sort of great success because we're still looking to account for the rest of the $10 billion in customer assets that Celsius has on its books. And so far it has people have only been able to isolate and find about 1.5 billion of these in public wallets. And there is a lot of thinking that Celsius has failed to isolate the risk. They might have taken USDC and held it in UST, or taken Ethereum and held it in staked Ethereum. So what happens is that when all of the crypto drops and all users want their fund back, all Celsius users feel the pinch because Celsius has so much in staked Ether and UST at the time in their portfolio, and it's using this to generate returns using their customers' deposits, that if the prices of those coins drop or if the peg is no more, then every single customer suffers the brunt because all of the customers' funds are pooled into one and then used to generate income. So what happens is that every time there's a big liquidity crunch, it makes DeFi feel a lot like traditional finance because it leaves a centralized platform in control of people's ability to access their funds, or lack thereof, because at the moment, people who have put their trust in Celsius, who have placed their money with Celsius, they don't really have access to their money because withdrawals have been halted, and it is more like a bank run. So if you think in the traditional sense, it sounds a lot like bank runs. Let's think about 2008 with the Lehman Brothers. Lehman Brothers was facing a liquidity crunch and it halted withdrawals as well, and people couldn't access the money that they had put in the bank. So what happened then? The bank went bankrupt, people didn't get their money. And this might happen, but it is a waiting game. They are looking to get more liquidity in their portfolio in order to stabilize the pool and be able to pay back. So as I said before, it feels sort of like traditional finance, because every time you see such a liquidity crunch, it just reinforces the point that you're relying exclusively on these sort of centralized platforms such as Celsius. Even when yields are great, I think we're still giving up a whole deal of control. And props to Celsius team for going to great lengths to assure its customers that it would meet obligations. Celsius has reserves, and they say that they have more than enough Ethereum to meet obligations, and that's determined by their comprehensive liquidity risk framework. They have also added a lot more Bitcoin in their collateral. I think over 1,000 Bitcoin was added in order to add liquidity to their platform. So what that means is they can stay afloat for now. Even though withdrawals have been paused, there is some assurances to investors that, you see, we have so much liquidity now, or added liquidity from our backup, that the company won't go bust. So let's see how Celsius manages its reserves and manages customers' expectations in conjunction with its liquidity in terms of Bitcoin and Ethereum. And hopefully they can start with withdrawals once again. And hopefully this liquidity crunch is over sooner rather than later, because it has affected the rest of the markets. This liquidity crunch has caused the price of Bitcoin to drop below 23,000, is sending Ethereum below 1,200, is sending Cardano below 50 cents, and the whole markets are severely depressed at the moment. We are in a bear market. Risk is incredibly high, fear is incredibly high, and hopefully we can get out of this rant sooner rather than later. So that's it for today's video. Thank you very much for watching. If you enjoyed it, please leave a like, hit the subscribe button, and share this video with your family and friends. Invest wisely. Cheers.